This is Australia's newest iron ore mine. It's one of 3 new sites opened by our biggest producers in the last 18 months. BHP, Rio Tinto and FMG hope to extract another 145 million tonnes of iron ore a year. For FMG, this project has been a long time coming.
Iron Bridge was one of our first projects we looked at back in 2003. We've spent $1 billion on it, a decade of making sure we get all the technology settings right.
It's due to export its first load by March. Last year, FMG shipped 189 million tonnes of iron ore. Once Iron Bridge is fully online, it'll add another 22 million a year. Rio Tinto's newest mine, Gudai-Darri, shipped its first ore a few months ago.
We'll provide around about 43 million tonnes of capacity as we continue to ramp that up.
The biggest of the 3 new mines, BHP's South Flank, has been operating for about 18 months.
We've still got a little more than a year to go, I think, before we start to consistently get to that 80 million tonne per annum rate.
Some of the new output from the big 3 is to replace older sites, but ultimately more will be mined, and the timing to increase supply couldn't be worse.
The iron ore price has been particularly weak in recent weeks.
China imports about 3/4 of the world's iron ore, but ongoing COVID lockdowns and developer defaults have sent its property market into a tailspin.
And that's been traditionally, for the last decade or two, it's been probably 1/3 or more of China's steel demand, and therefore over 1/6 of global steel demand.
Higher interest rates globally are also dampening demand. The value of Australian exports are down about $40 billion from the peak, with the price at about 1/3 of its roughly $240 high last year, now about $85 a tonne. As China's demand keeps slowing, there'll be less need for iron ore from the Pilbara, and that's likely to see the price keep falling. The Treasurer isn't relying on higher prices to boost the budget.
And we've taken a really responsible approach to that and banked almost all of the revenue surge over the next couple of years.
Andrew Forrest says good business sense will see operators ride the price downturn.
All you do is keep your costs way, way below anything the iron ore industry could ever afford, and then you're okay.
But for those with tight margins, it will start to hurt.
The key for the market now will be to come to grips with where cost support kicks in and start to pressure iron ore miners to stop mining because they're losing cash.
Rio's not giving off any concerns about a cost crunch.
We are seeing some short-term weakness, but the long-term future for the iron ore business is strong. The world continues to need steel and will continue to need steel for the lives people want to live, as well as future decarbonisation.
And BHP has further expansion in its sites.
We're currently studying growing the business to 330 million tonnes per annum. We're feeling pretty confident the market will be supportive of a production level in that type of range.
UBS thinks the price isn't far from its bottom, which would be welcome news for the miners.